This would lead to the idea of beta and alpha, which every quant is actively chasing today. What I have here is an animation for you of the practical implications of Sharpe's work. This is looking at only one price risk factor. But this founded the entire body of literature for further work, Fama French, 3-factor, 5-factor, factor zoos, so on and so forth. What you're observing here is, on the left, a portfolio outperforms the market with a Sharpe ratio of roughly 2.5. On the right, we have another portfolio that outperforms the market with a Sharpe ratio of roughly 2.5. In Sharpe's perfect world, with the capital asset pricing model, both portfolios should be just a form of leveraged market returns. But in practice, the market does not perfectly account for all of the returns available to us. The market is not perfectly efficient. And what you're seeing here is on the left, the portfolio that outperforms the market is just taking on extra market exposure. That is what you're seeing here. The returns are highly correlated. Everything about this portfolio outperforming the market is just a leveraged version of the market itself. There is no outperformance in that sense. It's only exposure to the market factor. But the portfolio on the right here has absolutely nothing to do with the market exposure. If the market were to tank, this portfolio would tank alongside with it, and this one would continue to outperform. It is earning purely alpha. Now, in this model, we're only looking at one priced risk factor, this market risk. In reality, there are other forms of risk that are compensated in the cross section. And that is exactly what makes this work so important, so foundational. This is effectively telling us, are the returns that we're observing in our portfolio a result of exposure to the market or another price risk factor, or is it some form of unexplainable skill or taking advantage of a structural inefficiency, a mispricing? A very important work in the quantitative finance literature. By the 70s, a tremendous amount of work had already been done in portfolio theory and asset pricing, but the world was about to be changed forever, and that is, of course, by Black-Scholes in 1973 with their paper, The Pricing of Options and Corporate Liabilities. Now, the innovation came from the portfolio replication argument. Instead of trying to forecast the underlying asset prices, what they did was come up with this replication argument. In the assumptions of no arbitrage, continuous trading, frictionless markets, the price of the option must be equal to the cost of setting up and maintaining a hedge. What this did is it translated the world from one of risk, the so-called P measure, to one that is in fact riskless. If a change in the underlying asset occurs, you are perfectly hedged. If your portfolio then earns no risk, you must earn the risk-free rate. This innovation not only changed the way that we approach pricing, but it also gave us, of course, the incredible Black-Scholes implied volatility measure. That is, we could invert the Black-Scholes model, the solution to the Black-Scholes equation, to figure out in a forward-looking way how traders were pricing volatility today. What I have here is an example of the implications of the Black-Scholes model. The model itself assumes a geometric Brownian motion, and there's only one source of randomness in the stock price process itself, meaning that volatility is in fact constant. So if I was to simulate the geometric Brownian motion and price an option under the Black-Scholes framework, I would have to select the same volatility for every strike and every time to maturity. Now, the problem with that, as we are going to discuss in the next piece of literature, is that in reality, the volatility surface is not flat. Now, that doesn't mean that we can't use the Black-Scholes model to invert the volatility for every point on this grid. But what it does mean is that the inversion isn't going to yield a flat surface. It is in fact going to have some form of a skew or a smile, and of course the term structure relative to the maturity. Now, what you're seeing here in this simulation on the right is this idea of the risk neutrality. We have the P measure where in expectation we are bearing risk holding this underlying asset. We have a drift of roughly 18% in this example. But if we have risk neutral dynamics, then in expectation, we are just going to be earning the risk-free rate. That is what makes this market complete. There is only one source of randomness. So when we take a look at these two measures, the only difference is in expectation, we are going to be earning the risk-free rate. That is what it means to operate under the Q measure. Now, that's certainly some nice theory, but the real-world implications of this paper are absurd to say the least, not just in the implied volatility measure that we get, or even applying this model to real options, but that is in the context of market making. Years later, Feynman Cach in physics would connect parabolic PDEs, that is the Black-Scholes equation, which is just a transformed version of the heat equation, to the risk-neutral price guaranteed by the fundamental theorem of asset pricing. What does that mean for trading desks? Well, we can use this portfolio replication argument in more intricate models to derive a mid-price. Then we can bake in adjustments. We can adjust for counterparty risk, liquidity, profit, then quote our prices to a client. After studying quantitative finance at the undergraduate and graduate level, master's, PhD, I was not satisfied with the transition from academia to industry, which is exactly why I built quantguild.com to help you master your quantitative skills for roles as a trader, a market maker, or a quant in the financial services industry with an adaptive practice engine that scales with your skill level so you can progress to more and more difficult topics. Over 100 hours of lecture content taught by myself, everything from A to Z. We're talking about first principles to the postgraduate level in coding, stats, math, data science, research. The list goes on. Quant Guild is the platform that I wish I had when I was coming up to be a quant, and that is exactly why I built it for you guys. So if you're looking for roles in the financial services industry as a trader, a market maker, or a quant, check out quantguild.com to master your quantitative skills.